Picture this. It's the 1990s and Bill Bengen, a top financial planner, is staring at stacks of historical market data with one urgent question. How much can my retired clients safely spend each year without running out of money? And what he does, he combs through bear markets, every crash, and lands on what becomes the legendary 4% rule. But here's a surprise that nobody talks about. He didn't design it as a rule to live by. He built it for absolutely worst case scenarios, not everyday spending. I've seen retirees with $2 million portfolios basically eat ramen noodles because they're terrified of spending too much. Meanwhile, others with identical savings are traveling the world, helping their grandkids with college, and sleeping soundly at night. The difference isn't luck or optimism, it's strategy. So today I want to show you a different system, one that helps my clients understand if they can retire earlier, spend more freely, and enjoy their money. In this video, you're going to learn the hidden flaw in the 4% rule that keeps retirees living in unnecessary fear, 3 widely used withdrawal approaches from basic to advanced, and a withdrawal system that most advisors don't even know exists, and then how to determine which withdrawal strategy matches your retirement goals and risk tolerance. But first, I want to ask you a question. What if I told you that the difference between a mediocre retirement and an extraordinary retirement isn't about how much you've saved, it's about how smartly you spend your money? If you can think about withdrawal strategies like the thermostat in your house, and there are generally 3 popular ones that go from basic to advanced. Level 1, you can think of it like the manual thermostat. This is essentially the 4% rule. The idea is that you set it once and never really touch it again. Whether it's 90 degrees or snowing outside, your house stays exactly the same temperature. Simple, but wasteful and often uncomfortable. Level 2 is like the programmable thermostat. You can think this like guardrails. You can adjust it seasonally, warmer in the winter, cooler in the summer. But if there's an unexpected heat wave, you're stuck until you manually override it. Level 3 is like a smart thermostat, which are the dynamic risk-based guardrails that we'll talk about in this video. It learns your patterns, adjusts to weather forecasts, optimizes for efficiency, and keeps you comfortable while minimizing waste. Of course, this one is a little bit more complex to set up, but evolves with the changing temperatures in your house, in your retirement. Now, each approach requires different levels of involvement and delivers different results. Most retirees stick with the manual thermostat or the 4% withdrawal rate, even when they could easily upgrade. And by the end of this video, you'll know exactly which level fits your retirement goals and, more importantly, how to implement it. First, let's talk about the static approach, which is essentially the 4% rule, the manual thermostat approach. Like I mentioned, founded in the 90s, Bill Bengen original research showed this static withdrawal rate of 4% of the initial account balance with the withdrawal dollar amount adjusted for inflation in each future year was capable of surviving any 30-year sequence of returns found in history, and that was using a simple 50% stock, 50% bond allocation. Since then, he's updated this to closer to 4.2% if you have more equities or more diversified. But if you want to implement this static withdrawal strategy for yourself, and if you have $1 million portfolio, here's essentially how it works, right? If you have $1 million, you start with a 4% withdrawal, so $40,000, and then you continue to adjust for inflation each year. And of course, invest your retirement money accordingly. So next year, if inflation was 3%, you can draw $41,200 from the portfolio and continue that essentially for the rest of your retirement. And I would say this is the simplest to implement, and most people can easily comprehend this. But I want to show you a couple pieces of data on why this can be inefficient for you. This chart, which I'll pull up here, shows what sort of scenarios could come about from following a static withdrawal rate. So what this looks like visually is if someone started retirement with $1 million, followed a static 4% withdrawal strategy, took about $40,000 per year, adjusted for inflation over time, and had a 60-40 type portfolio. Each little line here represents one of 1,000 different outcomes from the strategy. For example, following this strategy, you put yourself in a position of either running out of money in 23 years. Of course, you can see there's only a 10% chance of that happening. Or there's also a 53% chance that you end up with more than your starting balance of $1 million. Let's look at 2 different examples of how this might have worked historically. And this data I'm using is from Income Lab, which does research on withdrawal strategies. So let's imagine you decide to retire in 1966 and follow that static withdrawal strategy. Now, unfortunately for you, 1966 was one of the worst times ever to retire. So if we use the same parameters, a 60-40, $1 million portfolio, and a static withdrawal rate, you unfortunately end up running running out of money. Now, if you're one of the lucky ones and retired in 1986 and started with a static withdrawal rate using those same parameters, your portfolio would do really well. In fact, your portfolio would actually go from $1 million to close to $3 million in today's dollars, even despite taking the same amount of money in real dollars as a person that retired in 1966. Now, this is the same strategy, same commitment, but two completely opposite experiences. Two identical plans, but drastically different outcomes. So my point isn't to bash this research, it's that it may not quite create the safety or maybe even the outcome that most people think will happen. Depending on you retire, you end up with a ton of money, like retiring in 1986 that you ended up shortchanging yourself, or you spent the same amount and exhaust your portfolio if you decide to retire in 1966. Now, I purposely showed you two extreme examples here, and nobody knows what type of market you're going to retire in, but if you're watching this, I want you to understand the trade-offs of using a rule of thumb. I don't have time to get into every single detail about the 4% rule because it ignores things like taxes or longevity, like if you live longer than 30 years or less. But what if there's a strategy that doesn't just stick your head in the sand? Let's now look at the cousin of the 4% rule, which is the traditional guardrails. So in 2006, someone said, we can fix Bang's problem, and his solution seemed like pure genius. This was Jonathan Guyton. His insight was brilliant. Why stick to rigid rules when we can be flexible? This is where Guyton created the guardrails, and it's exactly how it sounds. When things are going well, you get to spend a little bit more, but when things aren't going as well, that's when you tighten the belt. And there are a few rules to follow here. Number one, set an initial withdrawal rate. The research shows that a variety of initial withdrawal rates are possible for someone in their 60s. This might range from 4 to 6%. Again, this is not a recommendation, but just to give you an overall framework. The second thing you need to set up is an upper guardrail. So for example, if the portfolio withdrawal rates fall 20% lower than the initial rate because your portfolio value increases, you can give yourself a 10% raise. And then thirdly, you set a lower guardrail. So now if the portfolio withdrawal rate rises 20% higher than the initial rate because your portfolio value drops, you tighten the belt and reduce withdrawals by about 10%. Fourth, then you add in those inflation adjustments each year and adjust your withdrawals. But the caveat is that if the trailing 12-month return is negative, so if the market has a bad year, then you skip an inflation adjustment. And lastly, they factor in what they call a longevity factor, which basically where there's no lower guardrail triggered during the final 15 years of the plan. So when you're older, you don't have to lower your income. Now, I like this a little bit better than the static rate because it allows for flexibility. You're not just sticking your head in the sand and hoping for the best. You're a lot more dynamic. But although I think this strategy is more efficient than just static withdrawals, it's not without its shortfalls. Number one, it assumes inflation-adjusted spending over your lifetime, but as I've talked about in other videos, what the research and data shows that retiree spending actually follows more of a smile, where you spend a little bit more in the early years, the go-go years, and then your spending starts to drop in real dollars over time as you age, as you're probably not getting out of the house as much. And then the second issue with the strategy is that it only considers your portfolio as an income source, but in retirement, for 90% of you watching, this is not as realistic because you have income from Social Security. Maybe you have a pension, rental income. Maybe you're working some part-time job or you downsize, inheritance. All these are tons of different factors and that can make the actual cash flow picture for most families a little bit more complex. It might look more like this hatchet if we added other cash flows and follow that spending smile. The early years of retirement might mean spending a lot more from the portfolio than 4%, or the traditional guardrails would suggest, because we know that other income sources will eventually kick in and offset those higher initial withdrawals. What's also very interesting is when they did a historical backtest in this article by Michael Kitces, retiring in 1965, following those traditional guardrails during the stagflation years, again, one of the worst years to retire, you're forced to cut spending pretty significantly. And this chart is showing what would happen if we follow the Guyton-Klinger methodology. In each case, beginning retirement by withdrawing $43,000 from a $1 million portfolio, 60-40 bonds, you can see each red line would be a trigger for when you would actually lower your income to the point where it dropped to 54% from your original target at the beginning. It's not until years later where you start to get increases in income. It's like having a programmable thermostat works great until there's a heat wave. Then it cranks the AC so high that your electricity bill triples. The adjustment mechanism can be more painful than the original problem. Again, this is better than running out of money, like with the static withdrawal rate we showed earlier, but for some retirees, this might be too much of a hit to their standard of living. And a series of blog posts by Early Retirement Now ran the same backtest using guardrails, and it showed that January 2000 retirees, when they began with 4%, 5%, or 6% initial withdrawal rates, would have taken over 50% cumulative pay cuts during retirement. They said with this Guyton Klinger style, you replace the small risk of running out of money with a 4% rule with a moderate risk of large spending cuts through many years of your retirement. Now, you might be asking, why are these income experiences so poor? Well, the main reason is that the Guyton framework triggers withdrawals and spending cuts when maybe they're not needed. It might be overly conservative and tend to overcorrect, preserving far more capital than is needed at the cost of severe reductions in your standard of living. Now, again, this is a little bit more involved to implement, and I think including spending adjustments in retirement planning is a major step in the right direction. But finally, I want to show you a system that builds on both of the benefits of those two strategies, the 4% rule and guardrails, and it's a new way to approach retirement withdrawal planning. This is where the risk-based guardrail system comes in. It combines the good things of Monte Carlo as well as adjustments and the flexibility of traditional guardrails to help you avoid a bad sequence of returns when you retire. And I like it because it blends data and research with real life factors like retiring early, Social Security timing, longevity, rental income, taxes, and it can give us a better understanding of when to live it up and when we might need to tighten the belt. As you can see here on my screen, the risk-based retirement spending guardrails use the following rules to determine withdrawal adjustments in retirement. Number one, the initial withdrawal rate. We begin by spending an amount that has an 80% probability of success. You set an upper guardrail. If probability of success rises to 100%, you increase spending to a level that has 20 points higher risk. So then you go back to 80% of probability of success. Then you set a lower guardrail. If probability of success falls to 25%, decrease spending back to a level that has 20 points lower risk. That would move to a 45% probability of success. Now, while the upper guardrail seems pretty reasonable, many people may find the lower guardrail pretty surprising. Now, most advisors will recommend a plan that has a probability of success somewhere between 70% and 100%. So why would we let the probability of success get so low before making an adjustment? Well, the answer becomes clear when we start to shift our mindset from success failure to risk. Since this is an adjustment plan, we won't run out of money. We'll continue to adjust. So success and failure aren't really accurate here. So here's an example with this sample family, not real names, of course. They will retire this year, age 60 and 59. We can factor in longevity in the family along with their tax makeup, which for them we have to think about not only how much can we withdraw, but how much can we withdraw net of tax to still meet the income they need, because a lot of these traditional retirement strategies, even the two that I talked about today, do not factor in taxes. And there we can model out using the portfolio that we intentionally built for them as invested for retirement income. And what this looks like visually with those risk-based guardrails is that we can establish those upper and lower guardrails that are realistic to what they can spend based on their sources of income, not just a portfolio. And from there, we can monitor monthly and make any necessary adjustments they may need throughout the course of their retirement. So their portfolio balance is this dotted line right here, which we set their initial monthly spending at this dollar amount right here, net of taxes, and we monitor this every month to help them stay on track. Because markets change, your situation changes on an ongoing basis. So for example, there's a month where their portfolio hits this bottom guardrail right here, so this bottom value, we'd want to tighten the belt just temporarily. And instead of the traditional Monte Carlo probability of success, we run it in terms of what's called probability of adjustment. That way you're in the driver's seat to understand, hey, how flexible is our budget? How much in discretionary income are we willing to cut during our retirement? And if that's sustainable, what that might look like. And does that match our tolerance for being able to adjust? But after implementing hundreds of withdrawal strategies, I've learned that the best strategy isn't universal. There's no cookie cutter answer. The right approach depends on your values, your goals, and how much flexibility you're comfortable with. So again, back to level one, the 4% rule. Choose this if you value simplicity above all else. If you're willing to trade potential optimization for peace of mind and you're okay with the idea that you might underspend or leave tax opportunities on the table because the plan is easy to follow and you don't want to make changes year to year. Again, level two is the guardrails, the traditional Guyton guardrails, and you can choose this if you want some responsiveness without the complexity. Now, this approach builds in clear rules. If markets go up, you might give yourself a raise. If markets drop, you know when to pull back. It's great for DIY investors who are comfortable doing some annual check-ins and don't mind occasional adjustments to your lifestyle. But as we saw, some of those spending cuts can still be pretty dramatic. In worst cases, sometimes up to 50% because those rules are still based on withdrawal brands, not on how much risk you're actually facing in real time. And then level 3, the risk-based guardrails. You choose this one if you're the type of person that really just wants to optimize. If you have a little bit more of a complex retirement picture, you maybe want to spend more than normal with multiple income streams like Social Security, timing, pensions, rental income, and you want a spending plan that's very flexible instead of reacting to market movements alone. This method watches your overall healthier plan and makes targeted risk-aware adjustments and helps prevent overreacting during downturns and helps you have a line in the sand for when you can enjoy more. Now, this approach isn't for everyone. It requires good planning software and an advisor who knows how to interpret the results. And it could be overkill if you have a very simple situation, but for many, it strikes the right balance between peace of mind and precision. But of course, no matter which withdrawal method you choose, there's something even more foundational. Your ability to sustain retirement income is directly tied to how your portfolio is invested. Stocks, for example, play a critical role in outpacing inflation and fueling withdrawals over time, but too much stocks might put your plan at risk in not having the right types of stocks. That's why I put together a separate video on asset allocation for early retirement, where I walk through a case study using a $3 million portfolio and share practical frameworks you can use to align your investments with your income. You can watch that by clicking right here. Once again, this is Matt. I'm a certified financial planner advisor with 1 Degree Advisors. If you'd like to talk to me or someone on my team about your plan to retire early, you can click the link in the description below. We'd love to chat with you.